Hello and welcome to our lecture for topic 43, Income Tax Fundamentals and Calculations. This lecture will be broken up into several subparts. This is a large topic of the CFP exam, so make sure that this is you are studying this. Quite a few multiple choice questions and case questions are on this topic. So first, we're going to discuss some filing requirements. We're also going to discuss audits and penalties associated with audits. But more importantly, we are going to focus on our income tax calculations, including filing status, if you are single, married, head of household, and then AGI, adjusted gross income. This is the number that your actual tax is based on, and there are several inclusions and exclusions of AGI that we're going to talk about. Additionally, we're going to go over our standard deduction and itemized deductions. Itemized deductions are usually presented in Schedule A, and then we have our dependency exemptions and our personal exemptions. So we are looking now at individual income tax requirements. So now if you have individuals with income exceeding their standard deductions and personal exemptions, if you have dependents, you have to include them in your filings, and that could be unearned income for a total of greater than $1,050, or notice the key word there, or earned income that is greater than the standard deduction. Note the standard deduction changes every year. If you go to irs.gov and you get the tax tables, you will see those deductions each year. Then if you're self-employed with self-employment income, if it's greater than $400, you have to file taxes. If you are a citizen, you have to file taxes. It doesn't matter where you reside, and if you're an alien, a resident alien as well. So basically, there's usually a filing requirement for most Americans. Then we have due dates, right? So basically for individuals, we know it's the 15th day of the fourth month after the tax year, and it can be extended for up to 6 months. So that's usually about April 15th, and then you can extend it to about October 15th. Then for partnerships and S-Corps, that's a month earlier. That's in the third month, so that is March 15th, and that extension usually goes to about September 15th, give or take whenever the 15th falls. And corporate C-Corps are also the fourth month, similar to the individual returns, and also with the same extension of 6 months. Now, an extension of time to file does not give you an extension to pay. So normally when you make that, and there is a form, you have to file a form for the extension with the IRS. If you do not file that form and give those prepayments, if you so anticipate that you're going to owe taxes, there could be some penalties associated with that. So audits, returns are chosen randomly at times, and then when amounts disagree, this increases your chances. So for example, if you have a 1099 or a W-2 or a K-1, remember K-1s come from usually 1120s or 1120Ss, and then if those amounts don't agree, then you are more likely to be susceptible to an audit. Also, there is like a computer scoring program, and then it's supposed to select those items that are most likely to have underreporting income. If you claim a home office, that is a very difficult exemption to have, a deduction to have, so that's also susceptible to audit. There's percentages that you should be paying based on your AGI, remember, adjusted gross income. So if you have those percentages and they're kind of below, then you're more likely to have an IRS audit. So they're usually conducted by mail, which is nice, so the IRS employee doesn't really come out. But then there are some extensive, audits that can have an IRS personnel to your office or your place of business, and you are entitled to representation if you're under audit, so usually an attorney or your CPA or your financial planner. And basically you have 3 years from the due date to challenge that. And it's usually extended if there's something, like if it's a dramatic understatement or fraud. But I would say when you are in the IRS audit process, the best way is to make sure that if the onus is on you as a taxpayer. So if you truly do not have the supporting documentation to prove the number, you are probably more likely going to have to pay whatever fine there is. So after the audit, you either get a proposed adjustment and you pay the tax. And this right here would be my recommendation if it's something that you can live with and if you know that you might not have all the supporting documentation. But if you disagree, then you can appeal to the supervisor, and then they have 30 days to appeal to an independent service center, and if not, you can go to court on it. But I would say most, at least in my experiences, most of us just paid the tax. Then there's different courts that are associated with tax. And so you have your district court, and this you have to pay the tax before you file. And then you have the tax court, you have the circuit court of appeals, and obviously the Supreme Court. Very few cases are discussed at the Supreme Court level for taxes. Usually we kind of resolve everything at the district or circuit court. Now, the burden of proof is on the IRS, and it only applies if the taxpayer keeps the required records. So even though the IRS has the burden of proof, you as the taxpayer have to have the records, and you cannot hinder any reasonable requests. So if the IRS is asking you for supporting receipts or additional information on your revenues, and then you should not hinder that process. Also, your net worth must be under $7 million, and that is non-individual taxpayers only. And then the taxpayer, you may collect reasonable attorney's fees from the IRS if you prevail. Prevailing with the IRS is quite difficult. You do have to have meticulous records and make sure that everything reported on your tax return is supported. This is a rare instance, but it does happen. So, and hopefully nobody has to go through an audit. Then you have penalties. It's usually 20% if it's an understatement, and if it disregards the tax rules. And then if it's a substantial understatement, they may increases. But you also, if you didn't show reasonable cause and good faith, you might also get that 20% penalties. And then penalties for fraud can increase up to 75%. And you must be proven by the IRS and have clear and convincing evidence. So 20% is pretty much where we all land if there are penalties associated with it. And obviously, as the taxpayer, the onus is on you. So you should absolutely have everything set up and pretty much make sure that all your records are correct and that you're not, that everything on your tax return is as it should be. Because if it isn't, you'll have quite a tremendous amount of penalties associated with it. So now we're starting with the calculation piece. And this is, we're going to pick up on the second video here.